Hey guys, so with all the different information out there in the cryptocurrency space, I thought that I would put together some videos and presentations talking specifically about different cryptocurrency topics, trying to break it down into easy to understand concepts, just so that people can get initial understanding what it is that's going on and why people are so interested in the space. Not going to be talking kind of investing or financial advice. It's really just to help people understand what these topics are, like the technology behind it. And so that people are just encouraged to to learn more about the space. So if you're brand new to the space, you don't know what Bitcoin and blockchain technologies are in particular, and this is the right video for you. So just gonna jump into it. To start off, just kind of showing some of the topics that we'll talk about in this episode. First, going to be talking about just how we currently exchange value over the internet here in the U.S. in particular, but kind of all throughout the world. I think that's important to first frame, to first understand about kind of Bitcoin and blockchain tech. And in terms of Bitcoin, we'll talk about what the blockchain technology is. We'll talk about what the miners are, and then we'll talk about BTC, which is the currency. So again, hope by the end of this video, you at least have some good understanding of to the utility behind Bitcoin and why people are genuinely believe that this technology and Bitcoin is valuable. And I think that to help explain why Bitcoin has value, right, to explain that argument, it's important to first answer what was Bitcoin really trying to solve, right? And to answer this question, I'm going to pose two different arguments throughout this video. With the first one being was that Bitcoin was trying to create a digital payment rail for cash. And so when the internet first came out, there was a massive exchange of information going on, right? And the first problem that was naturally encountered was, okay, how do we exchange all this information without having any bad actors interfere with it or see the information that's going back and forth? So the creators at that time, they ended up building these different network protocols, right? That I think most people here are familiar with HTTP and emails, video conferencing, and these protocols are basically just a set of instructions for the computers to follow when sending and retrieving this information back and forth, right? But the problem was that once we were actually tried to do this for sending money back and forth, and we tried to digitally represent dollars on the internet, it was really easy for scammers and bad actors to replicate those digital dollars, right? And we just weren't able to come up with a protocol that allowed value transfer to be just as easy as it was like maybe sending someone an email, or to be like how it was back in the day where we would just hand someone cash and the transaction was settled, right? So in the 1970s, the US built the ACH network. So ACH stands for Automated Clearinghouse, and it's the network that is used to exchange all value electronically here in the US. So every single payment that we send electronically goes through this ACH network. This includes direct deposits from work, sending Venmo payments, government taxes, and the snippet here is taken from the ACH website, which just shows that last quarter alone, the value of these payments that was processed was $18 trillion. So it's a whole lot of money. And I know we haven't talked about Bitcoin yet, but I think it's important to first understand what ACH is, to really understand why Bitcoin has garnered so much interest. So what is this ACH network? The ACH network, the tech behind it is really just one big ledger system, right? Where all the ledgers are owned and managed by these different financial institutions. And so back in the day, before computers, each bank, they held a ledger, and this is how they manage all the balances and transactions of each of the accounts that existed within each of these respective banks. And the ledger has been used by hundreds of years for anyone managing finances. It's not just banks or companies, but also individuals. And still to this day, it's a tool that's being used. But the difference is that the ledgers are purely digital. And so if you have everyone that has a Citibank account has an account in Citi's ledger. If you have an account with Chase, you have an account with Chase's ledger. And each of these individual ledgers, again, it's built and managed by these different financial institutions. And these individual ledgers, they connect into one global ledger, which is managed by the Federal Reserve. So the ACH network, which is basically this communications network of value, where each bank is securing and upkeeping their own ledgers and using this global ledger of the Federal Reserve as the central authority that can look through all the transactions that are taking place and are being processed, and just make sure that there's no bad actors that are double spending dollars or creating new digital dollars trying to commit fraud, right? And the native currency, right, and the unit of account for this network is the US dollar. So this is what's being sent back and forth, but then also what's being used in the ledgers to measure the balances of these accounts, right? And this network, again, it's what's used for every transaction done electronically here in the US. So if you have a Chase account and you want to send money to someone with a Wells Fargo account, realistically what you're doing is you're first requesting your financial institution to say, hey, send money to this person. The bank now sends that transaction to the Federal Reserve. Once the Federal Reserve checks to make sure it's a valid transaction and there's no fraud going on, it then sends the money to the receiving financial institution, and then that bank places the money in the receiver's account. And throughout this transaction, each entity was making all the updates into their own ledgers, right? And realistically, you're not the only one that's sending this transaction, right? There's thousands of other people that are also requesting their banks to process these transactions. And because all the transactions have to go to the FRB, and the FRB has to check all the transactions, what the banks do is that they don't send your transaction right away, right? They hold on to it, they queue it up, and they basically send about 2 or 3 batch transactions to the FRB a day. And then each of those transactions contains thousands of different transactions. So maybe they'll send one at 1 p.m., another one at 3, maybe another one later in the evening, right? And the banks are basically doing this just to be more efficient, right, and kind of minimize the instances where there could maybe be like a loss or an issue with a transaction, right? But this is also the reason why it takes days for payments to settle, right? If you were to send something in the weekend, it won't settle until the next business day because the system isn't running, right? These are ledgers that are ran and managed by these different companies. So there's humans operating these networks during the business hours. And so going back to the first slide, this is just the answer that the U.S. provided to creating a protocol for sending money over the internet. And granted, this is just for the U.S., right? So if you want to send money to some other country, someone in another country would have to go through their versions of the ACH network, right? We would have to go through something that connects all these networks together. We would have to change the unit of account because there's another currency in this other network, so there's currency conversions, and all of that, it ends up being what causes all these delays in payments actually settling, right? And on top of that, the users of these networks, we become completely reliant on these financial institutions that are allowing us to send these digital transactions back and forth. So it makes people place a large amount of trust in these entities that are facilitating all these digital transactions. So enter Bitcoin in 2009. And so in this video, I'm going to talk about Bitcoin in kind of 2 parts, right? So that's Bitcoin with an uppercase B that you see here on the left, and Bitcoin with a lowercase b you see here on the right. Is also BTC, right? So BTC, this is the token, the coin that everybody is so interested in, right? Bitcoin with a capital B, this is the network that is actually used to send BTC back and forth. So I think Bitcoin with a capital B is the one that gets talked about the least. We've been talking about digital payments so far, so I think we're going to start off with Bitcoin with a capital B because I also think it's probably one of the more important ones. And so the Bitcoin blockchain, at its very essence, is one global, trust-free, decentralized ledger. So what all those words mean, right? The Bitcoin blockchain, first, it gets its name from because each block essentially represents one page in this ledger, right? So each time a block is added to the blockchain, that's a new page being added to the ledger. And it has all the transactions that took place and all the changed and unchanged balances, right? For all the accounts. And the blockchain is just a collection of all these pages / blocks. And so we were talking about how the ACH network has each bank's ledger connected to the central bank's main ledger, right? Everyone's using the central bank ledger to check the transactions, and everyone's upkeeping their own ledger. Bitcoin is a network that has one global ledger. So instead of there being individual copies of separate ones, there's just everyone is sharing one copy of the same ledger, and everyone is maintaining the same copy of the same ledger. So because everyone is doing this, it completely eliminates the need to have to go through all these steps where you have this central authority that is going through to check that no one is double spending or being malicious with the coins in the network, right? And so just like how the ACH network has the USD as its native currency, the native currency of the Bitcoin network is BTC. So BTC is what we can send back and forth in the Bitcoin network. And the most important detail about the Bitcoin network is that it's a completely open network, right? So much like the current internet today, right? With the ACH network, only the financial institutions are basically able to initiate transactions on behalf of accounts that live in their ledgers, right? So with Bitcoin, any individual or entity can simply plug in and connect to this global digital ledger and initiate transactions themselves. And we're able to do this with things called wallets. So there's all these types of crypto wallets, whether it be a software wallet, which is like a computer application or a phone device application, or an actual device like a USB or something like that. And these wallets, they store your crypto funds, but they allow you to create and have an account on this global ledger, right? And I'm not going to get too into detail on the wallets because I think it requires just its own whole video talking about the different kinds, how they work with the tech behind it of public and private keys, the impact of holding your own funds, which I think is significant. But one big misconception that I do want to address in this video is the difference between having your own wallets and having an entity like Coinbase or Gemini essentially help connect you to the Bitcoin network. And all the other cryptocurrency networks that are out there. The digital wallets, they allow anyone to create an account in this Bitcoin ledger and begin making transactions. But when you're on Coinbase or any of these other crypto exchanges out there, you do not have your own wallet, right? Or your own account with the Bitcoin ledger. What these exchanges are doing is really no different from what the banks are doing right now, where they provide the service of connecting you to the ACH network, right? Coinbase and Gemini are essentially connecting you to the different cryptocurrency networks that are out there and allow you to have an account on their ledger, right? And that's and they have the balances of all your different cryptocurrencies that you have, right? But so I still think that these establishments are ultimately great for the space because they're essentially helping ACH individuals with ACH accounts initially connect into these different cryptocurrency monetary networks or networks in general, and then you can have funds and then take them to your own wallet, so then you have your own custody and can initiate transactions on your own. But again, it's very different from having your own wallet. So quick aside there, going back to the main Bitcoin ledger piece, the main point that I want to make is that it completely eliminates the need of needing a financial institution to actually send someone money electronically, right? So anybody can get a wallet, anyone can get an account in this Bitcoin ledger and begin making transactions. So I think the most important detail about Bitcoin, and the one that is exciting people the most, is that it is allowing the exchanging of value over the internet without the need of a third party to facilitate that transaction. And so I think Bitcoin was able to solve that problem from the beginning of the video, where it creates a protocol for sending money back and forth. So, and unlike the ACH network, where it's a highly permissioned, very closed system to be a part of, Bitcoin is just as open as the internet, right? An illegal immigrant may not be able to, or a refugee of a country may not be able to open an account with the ACH network, but they certainly can plug in if they're connected to the internet and have a wallet. They certainly can initiate transactions using the Bitcoin network. So again, it allows anyone with connection to the internet to send anyone money without having to rely on some type of financial institution or wiring company, some central company. But then the next question, okay, if there's no central authority or any companies running the network, how it is with ACH, well then who actually owns Bitcoin, or who's responsible for managing these networks? So in very similar, in the same way that nobody owns these HTTPS protocols or email protocols, no one owns the Bitcoin protocol, right? There's tons of companies that utilize these protocols, like Zoom for video conferencing. There's email providers for Yahoo or Google, but these entities, they don't own the protocol, right? So the same thing with Bitcoin. Although there's no owners of the network, there are entities that actually manage and run the Bitcoin network. and they're the ones that are responsible for maintaining this global ledger. And these entities are called the miners, right? So the miners are the ones that keep the network turned on and perform that service of processing the transactions and updating the ledger. And the Bitcoin network was designed so that basically any computer or device can connect to the Bitcoin network, download the Bitcoin software, and become a miner. So whether it's a small laptop or a supercomputer, because it's open, just like the internet, anyone with any amount of computing power can connect to the Bitcoin network and help maintain this ledger. So obvious question though is, okay, what's the point of becoming a miner? Like, why would anyone be incentivized to provide this computing power to be able to make the Bitcoin network run? So going back to the ACH network, these financial institutions, they're spending millions of dollars on employees, resources, just so that they can be able to be part of of this ACH network and process transactions. And their incentive to invest this capital and be part of this ACH network are the fees that are generated from facilitating these transactions. So, I mean, last year it was about over $60 trillion that were processed in the ACH network, and just 1% of that, a small portion of that is extremely significant. And there's fees that are being generated from all those dollars being processed. So everyone wants a piece of that pie. And the story is really similar with the Bitcoin network, where miners are able to earn revenue from the fees of processing a transaction and adding a block to the blockchain. And so in order to initiate a transaction in the Bitcoin network, there is a fee that is charged to the person that's actually initiating the transaction. It's basically like a tip that you're sending to the miners so that they're incentivized to actually process the transaction. And the fees end up being kind of a central design component, just because they not only prevent spam transactions, for somebody just clogging up the network by sending a ton of transactions, since they have to invest some capital to do it, but it also encourages these miners, right, to actually provide the computing power to process these transactions because they want to earn those fees. But Bitcoin has its own unique version of the pie that everyone wants a piece of, because not only does it consist of these fees, but it also includes these newly mined Bitcoins that you can mine from the blockchain. And I'm gonna talk about that in a little bit more detail in some later slides, because it's very important. But before we even get there, I think there's some important questions that we first need to address and need to kind of understand. And so those two questions: one, if anyone can connect to the network and be a miner, then who gets to keep this piece of the pie, right? And not only that, how do we encourage all these miners in the network to stay honest and maintain this global ledger and not make their own changes to the ledger just for their own benefit, right? How can we encourage everyone to stay honest, these random market participants to stay honest? And the answer to that is competition. So this is where the true kind of innovation of the Bitcoin blockchain comes in. And I think it's the part that's really ignited the space of cryptocurrencies and blockchain in general. And so what the miners they're essentially competing to be able to add a block to the blockchain, right? And this is where the big buzzword that's being thrown around comes in, called proof of work. So proof of work is a process that determines in the network of which miner gets to add the next block to the blockchain and get it to keep a piece of the pie. But it's also the way that we achieve consensus from all the miners that are in the network on what updates we're making to the pages in the ledger, right? Or the blocks in the blockchain. So it basically means that if a miner wants to receive the block reward, they must prove that they did some work to receive that reward. And so I'm going to try and go through, I think, what's really a brief summary of proof of work, since there's really tons of information out there and it's a very technical kind of stuff. But I'm just going to try and give a simple explanation of how proof of work is involved by just talking about how one block is added to the blockchain. So when people are initiating transactions on the Bitcoin network, they're broadcasted publicly to all the miners. So here's all the bankers on Wall Street. Back in the day, they would announce what transactions they were trying to make so that somebody could process it for them. Same thing's kind of going on here. People are broadcasting their transactions. The miners are collecting all those transactions electronically, and then they make the updates that they need to the ledger. And while this is going on, though, all the miners are also competing to solve what's sometimes called the proof of work puzzle. So this proof of work puzzle is essentially computers scanning through a ton of different numbers to basically attempt to guess the right number, right? And so the more guesses you make, the faster that you make them, the better chance you have of finding this puzzle. And once a miner solves the puzzle and guesses the correct number, they broadcast it out to the Bitcoin network that they solved this puzzle. And this is the miner's proof of work, right? Them broadcasting out that they spent all this computational power and energy to guess the right number gives them the ability now to earn this upcoming piece of the pie. And this is important because it forces the members that are involved, that are trying to get a piece of this pie, to have to expend some type of energy and effort, right, and work, right, in order to get their skin in the game. And so what happens? All the other nodes now, they're disappointed that they're not going to be able to get this piece of the pie. They check to make sure that the miner truly did solve the puzzle, right? They're incentivized to make sure that this person should really earn it. And they're also checking that the copy of the ledger that they want to add to the blockchain matches what everybody else has. So once all the nodes agree on all the transactions and that the miner truly solved the puzzle, the block is added to the blockchain, and all the transactions that were taking place, they settle, right? And as a reward for expending that time and energy to solve the puzzle, the miner is given this Bitcoin block reward, which again is those fees, but then also all the newly minted Bitcoins that come from the blockchain. And this block reward is that main incentive that encourages the miners to not only contribute their computing power, right, to try and solve this puzzle and earn the reward, but it also encourages the nodes to continue reaching consensus and adding pages to the ledgers so that they can continue competing for those rewards. And so if the miner were all of a sudden to credit himself, the miner who solved the puzzle, give himself more Bitcoins, then the miners would reject the puzzle. Right? They would reject the puzzle and look for someone else to solve the puzzle or solve the puzzle themselves and provide an actual accurate copy of the ledger, right? So this is basically done until a miner actually solves the puzzle and achieves a consensus from the rest of the network to add the new block to the blockchain. And this process continues block after block. As long as there's people out there making transactions, the blocks will continue to be to get added to the blockchain, and the Bitcoins will continue to be mined. And so I think that's a lot to unpack, and I really just briefly went into it. It's one of the more technical parts of this whole space, and I'm going to try and include just like more links that could be helpful to learn more about this. I'll put the Bitcoin white paper where the anonymous creator kind of goes through in more detail some more attack vectors that could exist, but mainly talking about the security of the Bitcoin network and why the design is able to work so well. And I think this whole field of mining is incredibly interesting, first of all, because people have valued holding BTC so much, right? The currency, and having the ability to move value back and forth electronically. Miners are investing millions of dollars in these mining operations, right? And you can see here these insane, warehouses full of specific machines, so specific computer and hardware that all it can do is solve this puzzle and process Bitcoin transactions, right? So the competition is really mind-blowing. I'll try and put some cool articles there. I do think that Bitcoin mining will also be a ginormous topic geopolitically, just in the next decade, because if anybody can plug into this network and become a miner, in a network that's already seeing trillions of dollars flowing, I think a lot of people are going to want to plug in and earn a piece of that pie. And countries may also just be incentivized to just hedge and join this network just so that they can have a say. So that's I don't want to rant too much on that. But again, really interesting. Encourage you to learn more about this space for sure. So again, it took a little bit to answer that first piece of, what was Bitcoin trying to solve for the digital payment rail for cash. It's definitely one of the more technical pieces, right? And I think people just don't talk about it enough. So I wanted to spend some time talking about it just because it is very significant. I think this is why people are so jacked up about this space, right? Again, it was trying to show that it's something essentially competing with these other monetary networks like ACH with the US dollar and other countries all over the world, right? SWIFT is basically what connects all the ACH networks with all the other global networks out there, for wiring and stuff like that. But again, this is essentially what this Bitcoin network is competing with, right? And in my opinion, it's only one of the things that Bitcoin was trying to solve, right? Of creating this digital payment rail for cash. The next one is the decentralized currency, right? So this is the second discussion point that I think I'm going to make on what Bitcoin was trying to solve, which was creating a digital payment rail for cash and also a decentralized currency that can be used by the participants of this monetary network. And again, all of this, these two main points, I think, is as to what make the argument as to why Bitcoin is considered valuable and why there's so much interest. And so Bitcoin with a lowercase b, this is what represents the currency within the Bitcoin blockchain, right? So this is what can be traded back and forth with the different wallets in the distributed ledger. And the Bitcoin currency, I think, has two major kind of characteristics that I'll mention here. It's like so many, but the ones I'll mention here, one, it's that economic incentive that for these miners to actually contribute their computing power into the Bitcoin network so the network can actually run. Since if they join, they have a chance to earn this BTC currency, both from the fees and the actual mining. But the second major characteristic is that there's no central authority that is quote unquote backing this currency, right? And I think it helps explain why we have this ability to mine the coins from the blockchain, right? Because the Bitcoin mining is providing this decentralized way to actually distribute these coins into circulation, because there's no central authority like the Federal Reserve or a central bank that is actually issuing these coins or this currency. And so this steady addition of a constant amount of new coins is, where each block, there's new Bitcoins being mined from the blockchain. It's very similar to gold miners using resources to add gold into circulation. So in Bitcoin's case, it's not actual mining equipment that's needed to mine gold from Earth. It's computing power, time, electricity that's actually used to mine these Bitcoins from the blockchain. And just like gold, Bitcoin is able to be mined by anyone that's willing and able to invest the resources and capital that are needed, right? So I think that's very interesting topics, and more on BTC. We start getting into some extremely unique characteristics about Bitcoin, because we're talking about how it's very similar to gold. We're not 100% sure if there's a finite amount of gold. There's about like a 2% or so increase in the supply of gold each year, and that is coming from just the miners digging it out from the earth. But we're not sure if at some point we'll run out of gold, right? With Bitcoin, the amount of Bitcoins that can ever be mined from the blockchain is capped at 21 million. So 21 million Bitcoins. And that started with the first 50 Bitcoins that were mined with the first block. And each block, it's bringing these newly minted Bitcoins from the blockchain into the real market, right? And with each block being added about every 10 minutes, which is on average how long it takes for the miners to solve this puzzle, there's more Bitcoins being mined from the blockchain. And about every 210,000 blocks, right, which is about every 4 years, that Bitcoin reward that the miners are getting gets cut in half, right? And this will essentially happen every 4 years until eventually there's 0 Bitcoins left that can be mined from the blockchain. And at that point, all the miners will just continue competing for the fees, which, if the network continues to grow at the rate it is, those fees could still be significant. So, and again, this is just slowly allowing a decentralized way to distribute all these coins into the market. And the idea also behind this capped money supply is that there's no central bank, right, that can go in there and adjust the money supply. Say like as a population of users grow, right? There's more people coming in, because if we were to manipulate that supply of Bitcoin, right, it would completely adjust the current value of the Bitcoins that are currently in supply, right? And the market would basically then have to adjust to these newly entered coins into the market, right? This is similar to what happens with our current fiat monetary networks, right? So in this sense, Bitcoin really just serves much more like a typical precious metal, where instead of the supply changing constantly to keep the value of the Bitcoin the same, which is what our central banks are trying to do with fiat and monetary policy, the supply is predetermined, and the value is essentially changing on demand. So as more network users as network users grow, then the value of the coin grows, and vice versa, right? As less users, less value for the coin. Now, it doesn't mean that not everyone will be able to have a Bitcoin, right? You can see here the same way dollars are broken down into cents, in the smaller units. The Bitcoins are also broken down into smaller units called satoshis, and that's after the name of the anonymous individual who originally proposed the Bitcoin protocol. And so one Bitcoin can be broken down into these 100 million Satoshis. And so you see here like the unit of measure for Bitcoin. So Bitcoin is really expensive today. It's about 30,000, who knows, 30 some thousand. But you could still buy $10 worth of Bitcoin and have some Satoshis. But not telling you to buy. Again, not financial advice, just making that point. And so now talking like USD versus BTC, I think that this can be a whole nother video, and I'm not gonna get too crazy into it because my intent really was to teach more about the technology and why people are interested. And so maybe I'll make like a specific video on this, but so I really just want to try and share some general questions that are, I think, relevant now. And so I think the big thing with Bitcoin, the currency, it has some incredible characteristics. Mainly, that limited supply of 21 million Bitcoins. But the main characteristic is that it cannot in any way be manipulated by the managers of this network, right? So in the past, to bring in more gold to the market, miners had to dig into the earth and they had to distribute it, right? And that was the old version of proof of work, essentially. And then once we move to these paper currencies that are managed by central banks, which is what our current monies are, the issuers are basically doing the same thing that the gold miners do. But instead of gold that they're bringing into the market, it's these paper currencies. And there's actually no energy spent to bring in these new US dollars, right? Other than just the time and energy that it takes to like make updates into the ledgers, into the computers that the central bank has access to. And so the central banks, they create money by purchasing different assets in the market. So they'll purchase like bond or equity securities that are usually held by big banks. And the banks that receive this newly created money, it now exists in the market, right? And then it basically trickles from the top all the way down. And only the Federal Reserve has the right to create these digital dollars, right? You and I cannot introduce a new U.S. dollars into the market because we would go to jail for counterfeiting. And this chart here, I think is relevant. I want to just shows how many assets the Federal Reserve has on their balance sheet, right? Because if they're buying assets, this kind of is a snapshot of how much assets they've bought, how much newly money that they've created. And it shows how in March of 2020, the Federal Reserve created trillions of dollars by buying a ton of assets from banks. And they did this because COVID, the ramifications of COVID, there's a lot of fears that it would cause a cascading amount of liquidations just all across the board on different credit markets, because just people were going to default on their loans, not being able to pay back their loans, and it would have wiped out a ton of value. And so the Fed basically did this as a response to ensure something like this didn't happen. And although it's nice to have a nice little life raft in the economy and in the markets like the Fed, to just make sure that markets aren't getting decimated, to think that something like this doesn't have a consequence, I think is naive almost. And so it's kind of the equivalent of gold miners out of nowhere absolutely flooding the market with an insane amount of gold, right? And whoever got that gold first will surely benefit, right? But over time, the value of gold will certainly adjust. So the same thing happened in March of 2020, and it's happening. And we're now in 2022. I think we can see what inflation is going on. But before I wrap it up on Bitcoin, it is important to say that although the open infrastructure is incredible, that anybody can plug into, it has some disadvantages when it comes to just serving as kind of like a true peer-to-peer payment system. And I'll try and put some articles that are kind of dogging on Bitcoin. I think it's important for you to get both sides of the coin. And so, as the Bitcoin network grew and got more crowded, it got slower, more expensive to use. Because you have to wait for those nodes to agree on the next page of the ledger, it takes time for the transactions to settle. It's not instant. So although it can be great for sending maybe huge payments, and cross-border payments, it's not really ideal for like buying coffee every day. And so I know that there is steps being taken to to kind of address this with like different L2 solutions, layer 2 solutions, a bunch of different people working hard to try and make it so that it can be a true peer-to-peer payment system. But I don't know if it's quite there yet in terms of adoption or where everyone's using it. So another downside to, obviously the Bitcoin currency itself is very volatile just as the market is trying to figure out what this should be priced at, as more network participants join and leave. So it doesn't really make that good of a unit of account like the US dollar. But on the other hand, the US dollar is also, subject to pretty inflationary monetary policies. Although it's a nice unit of accounts and we don't see it changing in our accounting books, the value of the US dollar is certainly changing. And the trust that we place in these central issuers to not debase the currency has been breached historically. And I think that's becoming way more relevant now since it has since maybe the 70s, which is the last time the U.S. experienced like a hyperinflationary period with the U.S. dollar. So I think, I'm starting to kind of wrap up now this whole thing with Bitcoin. I think Bitcoin with a capital B, when I think of all the different countries all over the world whose citizens don't have access to something like like we have here with the ACH, what other countries have with these electronic digital payment systems, they're clunky, they're highly permissioned, but they still function at such huge capacities with so much money being traded back and forth, and being able to do that from anywhere. That ability to trade through time and space has made our societies and our economies so much more efficient and grow so much faster because of that. But it does take time, energy, and true coordination and regulation to build up a system like that as a society and it be actually useful. But I think the most important detail about this, the systems that we currently have set up, is that it requires an immense trust to be placed on these entities that are facilitating everything, right? And we have to trust these financial institutions to be willing to take our request, to send money electronically, right? And before computers, value transactions, they didn't involve a third party, right? We would hand someone cash or some gold coins and, for a good or a service, and the transaction would settle right away, right? It wasn't until we started exchanging things digitally that we introduced these gatekeepers into the mix, right? And we've tolerated having these gatekeepers because it allows us to send money from one corner of the country to the other. But, censorship is not an uncommon thing in these types of monetary networks, right? We've seen banks close the ability for people to initiate transactions, saying, hey, you guys can't withdraw. We're closing the banks. That happened in the 20s with the Great Depression in the U.S., and it's happened, I think it happened in Turkey just earlier this past year in 2021. So same thing, individuals or enemies of the state, they can be targeted by these central banks and not allow them to initiate transactions. So something that happens very often, I think, especially in countries under authoritarian regimes, but it can happen anywhere. So again, we're left trusting these gatekeepers to facilitate all of our value exchanging going on the internet. On top of that, there's more trust being placed on these entities that they won't go into the central ledger and they won't create these new digital dollars or digital euros, whatever the case is. And so ever since we created the ability for the central banks to do this, the participants of these networks have always been subjugated to debasing of the currency. So it's happening with the U.S. Dollar. This slide kind of shows it pretty well. I think everybody knows that things get more expensive, right? And we're just kind of used to it. I don't know why. But the United States, we luckily have a pretty good monetary network. We have the strongest currency. We have, because we're the global reserve currency. But people in developed countries, they do not have access to these types of monetary networks that we do, right? Their banking systems are full of corruption. They're full of gatekeepers that have full control of who is sending what and where. And the currencies that they're forced to use are being completely subjugated to big time debasing by the central banks. So, and you can see here just recently what the current inflation rates are, right? Because all of this happened recently because of COVID, just all the money printing that was going on. The Bitcoin network allows these citizens and even just these countries to simply plug into the network, right? And the infrastructure and currency is just there for them to use. They don't have to set up this whole new version of their banking system that can connect to the global monetary networks that are out there, or retry a new fiat currency with the new central bank that won't debase the currency this time, right? The network, Bitcoin network, is just completely open for them. So I think that this can really allow developing countries in particular, and this is my opinion, to really quickly accelerate and become part of the global economy. It levels the playing field. And it also gives more power to the citizens that are part of the governments who are often censoring their monetary networks or manipulating them in any way, right? Because nobody can manipulate the Bitcoin monetary network. And the crazy part about it is completely global, right? It works regardless of borders or language. So I really do think that just as more people, more citizens plug into this network, it can become a dominant monetary network in the global economy. So, and I think you can certainly make that argument just looking at settlement volume and the fact that in less than 20 years of being established, it's already processing trillions of dollars in volume. So, yeah. So I think that really just kind of wraps up a lot of the arguments. This table here just kind of does a quick comparison and before, I think it is important to also call out that ACH has improved a lot in the past 10 years or so. With same day ACH processing, things like Venmo and Zelle basically got set up that allows instant settlement. And they basically do this by, from what I understand, just connecting different ledgers of banks together so that they don't have to go through the FRB. Maybe, but again, it's improved, right? I think a lot of that has happened maybe because of the competition of other monetary networks out there, like Bitcoin and all these other ones that are trying to compete. But I'm gonna try and do a brief comparison, right? Kind of, hours of operation for ACH. It operates during business hours because these are ran by companies. For Bitcoin, it's operating 24/7, 365. You can get settlement in the evenings, in the middle of the night. You can get settlement in the weekends, right? Permission to send value. The only ones that are allowed to send information and value back and forth in the ACH network are the financial institutions that are in there, right? With Bitcoin, anyone that has a wallet is able to send value, right? Accessibility to the network. Okay, well, not only is it limited on who can send value, but it's limited on who can actually set up an account, right? If you're a criminal or if you're an illegal immigrant, you can't set up an account with most banks. So you're basically just stuck using the cash monetary network, which that could be a good or bad thing, right? Not allowing criminals to join monetary networks. But I think there's also a lot of people that are on the bad end of that stick, right? Accessibility to the network of Bitcoin, you got a wallet, you got it on the internet, you're good. Owners of the network, NACHA. NACHA, and it really should be NACHA and FRB. NACHA is the nonprofit organization that manages the ACH network. They manage the rules and standards of the ACH network, and it's a nonprofit organization of basically the different financial institutions that are involved. And the FRB, they're also the ones that literally they dictate the monetary policy of the U.S. dollar. So they really do own that monetary network. No one owns the monetary network of Bitcoin, right? No one can control the monetary policy of the BTC. The only thing that can be managed is the consensus of the ledger, right? And that's achieved by all the miners. So native currency, ACH US dollar, Bitcoin, BTC. Issuers of the currency, the central banks are the issuers of the US dollar. Issuers of the currency for Bitcoin are the miners. Who owns the right to make the changes to the ledger? The financial institutions, they own the right to make changes to their own ledger. Transactions are often reversed. If we call your credit card company, I didn't make that charge. That they make those updates to ledgers all the time. With Bitcoin, you can't actually make previous updates to the ledger, right? That's the whole kind of immutable feature. But the people who maintain the ledger who can make new changes to the ledger are the miners, right? Settlement time, I put here for ACH seconds or days because I think we talked about some of those solutions that they put there. You can really get it done in seconds, but mainly it takes days. With Bitcoin, I put minutes and seconds because now seconds is somewhat possible with things like the Lightning Network, but minutes tends to be more accurate. But highly encourage you to do some more research on all this, right? I think all this is really important info to know, and again, I think it's hopefully by the end of this presentation, you've at least seen like why people are actually genuinely interested about this, right? And I think the last thought I'm going to share on Bitcoin is this is a screenshot of the first Bitcoin that was mined. Excuse me, the first block that was mined in the Bitcoin blockchain. So you're able to put like a little message in this block, right? And the first block was mined by the anonymous creator or the individual who proposed this Bitcoin protocol, right? And this happened on January 3rd, 2009. Right, so this is right after the financial crisis of 2008, and you see here this is basically a headline from a newspaper in the UK. It says Chancellor on brink of second bailouts for banks. So again, this is, and I think such an interesting thing to put in this first block, right, that's being mined. It's happened right after like a huge financial recession that was essentially caused by most of the financial institutions that run and operate the monetary networks that we currently use. And I just think the timing of this is almost like supernatural, right? For it to happen right after, and for this headline to be included in this, of when this first block was mined. I think that alone it's like a really cool clue that the anonymous creator kind of left us with as to maybe some of the motivation of suggesting and proposing something like the Bitcoin protocol. So these are I guess that's the end of the video here, right? Hopefully that you found this useful, and you were able to have a good idea of what Bitcoin and blockchain is in particular. I'm going to make more videos about just other topics in the cryptocurrency space. So if you do like this and you were able to sit through it wasn't super boring, just go ahead and like and subscribe and do all those things, and I'll come up with more content, especially if people like it. I put these pictures of these two legendary guys because I was the biggest crypto skeptic ever, mainly because like I look up a lot to these guys, and these guys are very straightforward kind of investors, and they invest in businesses. Bitcoin is by no means a business, and so I think Charlie Munger, the guy here on the right, is called Bitcoin is rat poison, and so I'm misquoting him here. But I think hopefully at least people can agree that it's probably not rat poison. Like what's going on here is pretty exciting, and that's why so many people are literally committing their lives to this space. So again, hopefully you enjoyed the video. I love these guys. I hope that hopefully maybe one day they turn around. But hopefully you also just found this insightful and are willing to just learn some more info about it. So thanks guys.